Have you ever wondered what really happens to your investments, property, and overseas pensions when you move or move back to the UK? Maybe you've landed a new job in one of the world's biggest financial hubs, want to be closer to family, or just need a fresh start. But here's what a lot of people don't realize. Moving to the UK is a tax event. Do you have to tell HMRC about your assets? Will the UK tax you on everything? And what if you're returning after years abroad? Do the rules change? In this video, I'll break it all down so you know exactly how the UK treats your overseas income and investments, what to report, and how to avoid getting caught out or paying tax twice. Everything starts with your residency status because that's what decides whether the UK can tax your overseas income. HMRC uses something called the statutory residence test, which looks at how many days you spent in the UK and your ties here, like family, work, or property. You'll be classed as a UK tax resident if you meet one of the following UK automatic tests. You spend at least 183 days in the UK during a tax year. Your only home is in the UK for at least 91 consecutive days, and you stay there at least 30 days in a tax year. Or you work full-time in the UK for 365 days and at least one of those days fall in the tax year being tested. If you meet one of those UK tests and none of the automatic overseas ones, you're a UK resident for tax. Otherwise, you're non-resident. It's also possible to be resident in two countries at once. In that case, a double taxation treaty decides which country gets the taxing rights. Once you become UK resident, HMRC can tax your worldwide income and gains. Basically, if the money comes from outside England, Scotland, Wales, or Northern Ireland, HMRC treats it as foreign income. That includes income from the Channel Islands and Isle of Man. First, let's start with foreign income. Once you become a UK tax resident, HMRC expects you to declare your worldwide income, not just what you earn in the UK, even if you already paid tax abroad. That includes salary or wages from abroad, dividends and savings interest, rental income, and pension income. You usually report this in the foreign income section of your self-assessment tax return, unless your only foreign income is dividends, and your total dividends, including UK ones, are within the £500 dividend allowance. If your old country has a double taxation agreement with the UK, you can avoid being taxed twice by applying for a certificate of residence from HMRC. If you've already paid tax abroad, you can claim foreign tax credit relief, meaning you only pay the difference if UK tax is higher. But from April 2025, there's also the Foreign Income and Gains Regime, or FIG, which can go even further. If you've been non-UK resident for at least 10 consecutive tax years, you can, for up to 4 tax years after arrival, exclude qualifying foreign income and gains from UK tax, even if remitted, by electing or claiming it each year. It's a huge benefit, though you lose some UK allowances for that tax year, including your eligibility for child benefit and tax-free childcare. And it doesn't cover foreign wages. For that, there's overseas workday relief. If you've recently moved to the UK but still perform part of your work overseas, overseas workday relief can help you reduce your UK tax bill. OWR lets you exclude the proportion of your employment income relating to duties performed overseas from UK tax. You need to make an election in your self-assessment return each year, and you lose your personal allowance and capital gains tax annual exempt amount for that tax year. If you're not eligible for either or decide not to use them, HMRC taxes your worldwide income in full once you're a resident. So here's the bottom line. Once you move to the UK, tell HMRC about any foreign income. Check whether you qualify for Foreign Income and Gains Regime, overseas workday relief, or foreign tax credit relief, and make sure you apply early for any tax treaty exemptions before being taxed overseas. Now, let's talk about investments, things like stocks, ETFs, or mutual funds held abroad. Once you become UK resident, any profits made after you move are usually taxable in the UK and need to be declared in your self-assessment return. So, if your overseas shares rise in value after you arrive, you might owe capital gains tax when you sell on total gains above the £3,000 capital gains tax allowance. You may qualify for relief under the FIG regime or claim foreign tax credit relief if you've already paid tax abroad. Be aware of non-reporting funds, offshore funds that don't report income to HMRC. Gains on these are taxed as income instead of capital gains, with rates up to 45% depending on your tax band. And if you own property abroad, any rent or sale gains are usually taxable in the UK once you're resident, though you can claim credit for any foreign tax you've already paid. If you're finding this video helpful so far, give it a like. It really helps more people see this. And if you're living abroad or planning a move to the UK, drop a comment with your situation below. And don't forget to subscribe for more UK investing and personal finance videos just like this one. Now, let's talk about pensions built up abroad. Once you become UK resident or were resident in any of the previous 5 tax years, most overseas pensions are taxable in the UK even if they were tax-free abroad. You generally have 3 options. 1. Cash it out, though this can trigger tax in both countries. 2. Transfer it to the UK, but only if it's a recognized overseas pension scheme. Most US 401ks don't qualify, and even eligible transfers can face a 25% overseas transfer charge. 3. Leave it abroad and declare any withdrawals once you start taking them. Keep in mind, some pension providers restrict what you can do from overseas, and you need to comply with both UK tax rules and your old country's regulations like FATAC or FBAR reporting rules for US citizens. If you're unsure, it's always worth speaking to a cross-border tax specialist before making a move. What about cryptocurrencies? Once you're UK resident, any gains from selling or trading crypto are subject to UK capital gains tax. HMRC already works with major exchanges like Binance and Coinbase, so reporting isn't optional. You must declare gains when you sell, trade, or spend crypto and pay tax on profits above the £3,000 capital gains tax allowance. And if you're paid in crypto, that counts as income, meaning it can also be taxed and subject to national insurance. If you're returning to the UK after years abroad, the temporary non-residence rule may apply. If you were non-resident for fewer than 5 full tax years and realize gains or take pension withdrawals while abroad, the UK can still tax those once you're back. You might also qualify for split year treatment, dividing the year into non-resident and resident parts. That can help time bonuses, investment sales, or property disposals before arrival. It's always worth getting professional advice before making big financial moves if you plan to return. Let's look at a few examples. Aisha arrives in the UK on 10th of June 2025 and works both inside and outside the UK. Because she hadn't lived in the UK for the previous 10 years, she qualified for overseas workday relief and split year treatment. Her qualifying foreign employment income for 2025-26 tax year is eligible for overseas workday relief. If she remains resident in the following 3 tax years, she could keep claiming overseas workday relief. She claims it in her self-assessment each year, giving up her personal allowance but saving tax overall since much of her income is earned abroad. Next, we have Mark. Mark moves from New York to London with a 401k worth about $180,000. He left it in the US, and when he starts drawing it later, both the UK and the US can tax it. However, under the UK-US treaty, he can claim foreign tax credit relief in the UK to offset US tax already paid. As a US citizen, he must still file annual US tax returns and comply with FBAR and FATCA disclosures. By doing this, he stays compliant in both systems and avoids costly surprises later on. Or take Anna. Anna moved from Germany to Manchester in July 2025. She has a European general investment account with a portfolio of stocks and a pension from her old employer. Because she became UK resident partway through the year, only the gains realized after arrival are taxable in the UK. Before moving, she sells part of her portfolio and later transfers her European pension into a recognized overseas pension scheme, since her provider is listed on HMRC's ROPS register, avoiding double taxation and optimizing her move. Here's how to stay on the right side of HMRC. 1. Declare all foreign income and gains on your self-assessment, even if tax was already paid abroad. 2. Apply for a certificate of residence to reduce or avoid foreign withholding tax where a double taxation treaty applies, or claim foreign tax credit relief if tax has already been paid abroad. 3. Review or close any non-reporting offshore funds before moving. 4. Get cross-border tax advice if you hold complex assets, companies, or trusts abroad. 5. Use HMRC's worldwide disclosure facility to fix any undeclared past income. 6. If eligible, consider overseas workday relief or the foreign income and gains regime. 7. If returning after years abroad, check if temporary non-residence or split-tier treatment applies. They can make a big difference. 8. For new money, use UK tax shelters like ISAs and pensions to stay efficient. So, what's the big takeaway? Moving back to the UK is more than just a change of address, it's a tax event. Once you're resident, HMRC can tax your worldwide income and gains from investments, property, and pensions. Knowing the rules early can save you stress, penalties, and a lot of money. The key is to plan before you move, structure things smartly, and use the system to your advantage. If this helped you see the bigger picture around moving to the UK, give it a like and share it with anyone who needs it. And don't forget to subscribe for more breakdowns like this one. Thanks for watching, and I'll see you in the next one.